Okay, good afternoon, everyone. My name is Marissa, and I will be your administrator today. Welcome to the July 2023 First Friday webinar. Today's presentation is about how to build a wish list, which will come in handy if our U.S. economy goes into what we believe will be a downturn. Our prepared comments during this session will be recorded, as other families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be between 15 and 20 minutes long, with some time left over to cover questions from the participants, along with our standard topic, which is what is the market missing? If you have already sent your questions, we want to thank you because your questions help us understand what topics are truly important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question in the chat box, or write it down and raise your hand at the end by clicking on the icon at the bottom of the screen. And we will do our best to come to you at the end of the prepared comments. One final note, please remember to mute your device's microphone and to stay on mute, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Well, welcome everyone to July's First Friday discussion. And as always, thanks for setting aside some time to talk about some topics that are sort of increasingly important to each of our families' financial futures. Today, we're going to do something just a bit different, and we're going to discuss a completely optional target or topic. It's not a topic that anyone needs to do for sure, but I think you'll find it stimulating and actually fun. It's a topic I often hear about during the beginning of a recovery in our economy after a painful downturn. And at times it's a debilitating downturn because people say, I wish I had. And this is sort of preparation for the I wish I had. Despite the reasonably high probability that our U.S. economy is heading towards a recession, many of you will find this topic invigorating and fun. And I would say while investors are more likely than not going to experience difficult times ahead, this discussion it often serves as a reminder that in general, our U.S. economy and capitalism in general is incredibly resilient. It always finds a way to turn difficult and trying times into wonderful opportunities for intelligent investors who are prepared. And that's what we're trying to do here. We're just trying to prepare for what lies ahead. So the topics today, I can get this thing to comply with me. The topics today we're going to cover will be, first, one of the families that we serve reminded us or asked us that we go back over the most important signals as the stock and bond markets really do seem to be ignoring what is likely to come, and they're looking through the most relevant indicators, all of which are pointing towards difficult times ahead. And while, of course, no indicators are perfect, when you have a confluence of highly predictable indicators, all pointing in the same direction, independent of each other, it would be foolish to ignore them. So we want to go over those. Afterward, we'll have a short discussion of what a wish list is and how to make one and when to make one. And more importantly, what questions to ask yourself to ensure you have the confidence to remain disciplined through the downturn, and I would say disciplined enough to stay the course when you start implementing the wish list. One final note, and that is as we move through this period, bear markets and the talking heads on TV and the press, they're all going to give you narratives that are incredibly negative. And I think that if you will remember that the United States and capitalism, as I said earlier, and capitalism in general generally finds a way to endure through these things, it'll make it a lot easier for you to implement and this wish list. And by the way, the question or the questions that we'll go over at the end will allow you to certainly remain disciplined. So first, let's quickly review the current leading indicators and what they're telling us about what lies ahead over the next 12 months. Remember, there are three almost infallible signals, and that's all you need to worry about. For those of us who are busy, just focus on these three indicators, and they're easily available in every newspaper or document. The signals are telling us the difficult times ahead. And while the stock market remains almost singularly focused on only the noise and the hype of disinformation, these three signals will give you the right directions moving forward. So the first is the US Federal Reserve. Is it adding liquidity or removing liquidity? Remember, adding liquidity to a debt-based economy that is the United States means that they're trying to increase economic activities, and removing liquidity acts as a depressant and decreases activity. So all you need to remember is don't fight the Fed. It's an easy saying to remember. And if the Fed is adding liquidity, it's increasing the economy, it's trying to increase the economic activity. And if it's taking liquidity away, it's trying to decrease activity. And the Fed is pretty, has a high probability of winning. Next, the yield curve indicator. If it's sloping up and to the right, as most yield curves are, it's a normal yield curve and all is well. The Fed is supporting the economy. However, if it's the exact opposite of that, if the yield curve is inverted, as we call it, it means the Fed is doing its best to slow the economy, and the vast majority of times, the Fed is going to win this battle. Make no mistake, the Fed will win. It means that banks have to pay more for short money that they use to borrow money so that they can lend long. So it is, it's a very reliable indicator. Next is the indicator or the index of leading economic indicators. And this is an index of 10 totally independent and largely unrelated indicators. And it's just that. It's just an index that tells you where our economy is likely to go over the next 12 months. And it's almost infallible. As you can see, this is a slide we showed 2 months ago, so sorry. And it shows clearly that the Fed is removing liquidity from our economy, and it hasn't changed at all since we put this up. This leads to a recession, and in almost 90% of instances. The yield curve is next, and as we discussed in May, the yield curve remains inverted, and today it's more inverted than it was in May. Every recession since the 1950s has been preceded by an inverted yield curve. Slide 7 is just the leading economic indicator index. and it continues to predict a recession in the coming year, despite the fact that the indicator has been flashing red for more than 12 months. Don't minimize its validity. As you can see from the chart, the leading economic indicator index has preceded every recession since 1950. Let's discuss the fact that indicators I guess all of the indicators we just discussed, what happens if they're wrong? What happens if it's possible? What happens if all of the indicators sort of pointing in the same direction were giving us a fake signal? So what are our risks there? Every self-respected analyst and every economist must deal with the fact that predicting the future is filled with uncertainties, and it means that you must have a plan B, or you must know what happens to you or what your risks are. What are you going to lose by being wrong? So what are our risks today if we're wrong somehow about the US economy? And what happens if we avert a recession? What happens if we don't go into a recession and our economy continues to grow like it has over the course of the last several years? This is a slide showing what we call the arithmetic mean. I don't want to get involved in the math behind that, but it just shows the current evaluations. The higher the valuation, the lower the future returns. That's just a constant. This chart clearly demonstrates that we are 2 standard deviations above the mean, which is, in normal language, it means that we're so highly valued that future returns are likely to be near or at zero or even negative. So the risks of our being wrong about a recession and not participating in an overvalued market are very low. This slide shows a different arithmetic sort of an arithmetic average. It's the geometric mean. So, I guess without going through the math, in short, it clearly demonstrates that we're, again, from another perspective that's independent of the arithmetic mean. It shows that we're 2 standard deviations above the mean here also, and it's just not welcoming towards any investment philosophy. So again, the message is that we're not likely to lose much appreciation by staying away from an overvalued market. This chart, along with the 2 other charts, clearly shows that the risks of being in the market today are much higher than the risks of being out of the market. So if you can see, I guess you can see this chart. It shows that the current valuation of the market is in orange. And then it shows that the yearly, I guess the yearly response to that 10 years behind it are in green. And what you can see is almost a perfect correlation of the fact that when the orange line is high, the green bars are low or very low or even negative. And what this is sort of telling us is this is a 10-year delayed chart with almost perfect correlation going back to the early 1900s. It just shows us that investors today in the stock market, regardless of whether we go into a recession or not, if we go into a recession, we're probably going to be in much worse shape. But it shows you that you have very little risk to being out of the market today. Very, very little risk. And to tell you the truth, you probably risk saving some money. So this chart, along with the other 2 charts, clearly show that the risks of being in the market today are much higher than the risks of being out of the market from our standpoint. And in summary, the signals are leading us to believe that we're heading into a difficult economic period. And if we're wrong, meaning the US economy avoids a recession, which typically destroys a significant amount of value, the gains that we're going to, I guess, not participate in during an overvalued market, they're going to be small. In short, the risks are high and the returns available for those taking those risks are small. Okay, so let's move from that downbeat message, sorry about that, into the wish list discussion. So what's a wish list? And as most of you already know, it's just a list of assets that you'd like to have if you could have them at a certain price you believe to be a bargain. So this takes place, for many people, this takes place in a housing market. It takes place in the stock market. It takes place in the bond market. It's a very prescient and thoughtful way to go about sort of setting your future up for success. So the challenge becomes making the wish list during times which are often really good, and having the discipline to stay on the sidelines until your price is met. I can tell you, after having been involved in the markets professionally for over 40 years now, the reason I bring that up is that I've heard hundreds of conversations about the fact that they just couldn't stay on the side. They knew that this was a valuable company, or knew this was a great house, and they had the right price. The price kept going up and up and up, and they couldn't stand it anymore. So they just paid up and they purchased the right asset for the wrong price. So this happens during stock market bubbles. It happens during housing bubbles. There are hundreds of thousands of people who experienced this during the great financial recession during 2008 and 2009. There are lots of people who experienced this during 1929 downturn, and there will be lots of people who experience this during the downturn that is to come. So, and I can relate to the fact that hearing the narrative around, a stock which is going to, which you feel strongly is going to be valuable in the future, and the price continues to increase, it's almost too much for you to bear. So don't make the devastating mistake of abandoning your discipline due to the siren song of what I would describe as momentary narratives told by the talking heads, and don't buy the asset at incredibly high values. It's the wrong strategy. So how do you make a wish list? It's pretty simple, and I'm not going to bore anybody with the actual specifics of it today, but I want to give you a couple of guidelines and invite each of you individually, because every one of the families that we serve has different goals and different levels of risk that they're willing to take. Invite you to work through this with me if you'd like. I've done this hundreds of times in my life, and almost every time it's been very, very successful. So here's what I would caution you to do. It is start with a sector level or a theme level. So one of the things that you might be interested in would be what would be disrupted over the course of the next 10 years. What's going to be disruptive, or what's going to take off? So a lot of you would say artificial intelligence, which has been the buzzword for the course of the last couple of months. That's probably incredibly overpriced, but it consists of some pretty good companies. There are some great companies involved with artificial intelligence. I would challenge you to think outside the box a little bit. For instance, instead of buying semiconductor companies, which certainly have been producing, or these semiconductor companies who were front and center about producing chips that are going to enable the artificial intelligence or the machine learning revolution, like NVIDIA and Broadcom. I would challenge you to think outside the box for companies like Qualcomm, or these are the second derivative companies that are going to be incredibly involved, or NXPI, which puts chips in cars that will be taken advantage of during the EV day, in the electronic vehicle days, or the proliferation of electronic vehicles. Think outside the box a little bit. And I would offer up education, for instance. So when you start thinking about artificial intelligence, you start thinking about what will become of artificial intelligence. And what I would say is it's going to become very individual. Every single person will have a personal assistant that will be a computer, and it will help you make decisions. It will help you think outside the box. You could have, I personally believe we're going to change the whole educational system. And most of you who've talked to me about this a lot know that I have very firm views that the educational system is broken. It's incredibly overpriced. People that exit the educational system is sort of exit it with tremendous debts. And the best sociology teacher or math teacher on the planet Earth costs the same money in Mississippi or Alabama that has or Louisiana that have very low standards. They're available for the same price over the internet. Artificial intelligence could become the perfect tutor. So my point is to think inside your specific sphere of competence, and think about what you know to be true. Many of us, many of you on the call are medical doctors. So think about how artificial, how would I say this? Think about the visual, or I guess the ability to extend the operating room to other areas of the country. All of these things, they're going to come true. Another trend that is probably going to take place that you may not be thinking about is reshoring. As the world becomes more bipolar, the East versus the West, and I hope that geopolitical conflagrations don't take place, but as we reshore and we change from our manufacturing processes from the least expensive to the most trustworthy, we're going to bring those things back on shore in the United States. We have tremendous amounts of energy here, and reshoring is going to be a huge theme for the next decade. And don't forget, it took us about 30 years to build these how would I say, supply chains, I guess we should call them. It's going to take us 5 to 10 years to build the manufacturing infrastructure in our country, and it's already started. We've seen tens of hundreds of billions of money coming into the semiconductor reproduction market, and that's going to continue. So reshoring, education, artificial intelligence, the application of artificial intelligence towards medicine and drug discovery, it's going to be on steroids. It really will be productive. So what questions should you answer, or should you talk about or think about when settling on a theme or an industry that you think should be part of the index? So I think the single most important question that needs to be sort of asked and answered is, regardless of the economic backdrop, will this industry survive and thrive? And the reason for that is the economy is going to be, listen, I've been trying to figure out what's going to happen with this economy for the past 2 years during zero interest rates and during interest rates rising at the fastest level that I can remember. And it's incredibly hard to figure out what's going to happen with our economy. Finding industries or themes that are not going to be disrupted by a bad economy it's easier than you think. For instance, cybersecurity. I can make a case that says that cybersecurity is going to proliferate. There's no shortage of bad guys out there, or bad people out there. So cybersecurity is one. Reshoring is going to happen. I'm telling you. Energy production. The stories about energy production going to zero and all of the energy companies going bankrupt, it's way, way, way too early for any of that. They've got decades ahead of them that we won't be able to have energy otherwise. Some of you may think about companies that are paying high dividends. That's another theme that may very well be part of I know it is part of what we do and what we think about here, is getting a return on our money. So I think if you will take some time and think about industries that are going to be resilient, that are going to take advantage of technology, that are going to take advantage of the natural movement of our society, I think you'll be in really good shape. So let me stop right there just for a second and find out if there are questions or comments, or I'm sure there may very well be, before we go into one last topic, which is a really fun topic, and it's, what is the market missing? And I have a really good one for you this week or this month. Marissa, do we have any questions?
No questions have been received in the chat just yet, but if anyone has a question, they can either unmute themselves and ask, or they can type it into the chat box at this time. But as of now, no questions have been received.
Okay, gotcha. All right, let's do this. So what's the market missing? So here we and I'll rush through this because I think we're getting a little bit. Yes, we're at the 30-minute mark. So let's do this real quickly. So everyone knows that earnings define asset prices. And everyone also, although you probably haven't thought about it, but profit margins actually define what your earnings are going to be. So I want to talk to you about profit margins right now and discuss whether you believe that they're stable or not. This is, I think, one of the most obvious bubbles that I've seen in the last 30 years. And then I want to tag along one topic that is it's not necessary right this minute, but I want it on your radar screen because it is likely the rate of change as we look at companies that are unprofitable is going to really increase over the course of the next couple of years, because don't forget, most of these companies were built during the 2008 to the current level, to current times, and all of that was during 3 or 4% interest rates, not 8 to 12% interest rates. So number one, real quick chart. You can see that the last time that profit margins were at levels near the levels of today was during the 2008, 2009, the beginning of the crisis. These are not normal levels. Remember that as an average, profit levels are somewhere in that 8 to 9% range. That's a healthy range. Anything above that creates incredible amount of competition coming into the market. Anything below that means real trouble, because these companies, or almost every company in the United States, is leveraged. This chart is by John Hussman, and he's he's a seer, or he's a smart guy. And this, I guess the point I'd like to make here is, what do you think is going to happen from this point on? Do you think it's possible that the profit margins stay at these levels or not? And this is another indicator that the stock prices are way too high. The point being, if profit margins come down, stocks are going to come down. And I offer this as an anecdote that may be valuable to you. Here's another canary in the coal mine. When GAAP earnings are below operating earnings, trouble exists. What that means is that how would I say this? Capitalism is rife with people who are creative and who are clever and not always honest. When they start showing you that operating earnings are actually way above GAAP earnings, which are defined by the accounting profession, what you're seeing is tomfoolery going on, and this is happening now in a very, very big way. So trouble ahead for the dishonest companies that are telling you that they're a lot more profitable than you think they are. So here's a chart that shows that over 40% of the Russell 2000 index of public companies doesn't make a dime. They're unprofitable. So my point here is, my worry here for everyone to keep on the radar screen is, these companies were created during the last 15 years with interest rates in the 2% to 3% range. Is it possible for these companies who were unprofitable and leveraged with rates at 2 to 3% can become profitable today with rates above 8%? And many of them are in double digits when they go out and when these rates, or when these bonds mature and they have to refinance themselves. My fear is that we face a cliff of significant bankruptcies in the future because of these unprofitable companies, having lived a whole life of 15 years with interest rates that were manipulated to be lower than they really are. And finally, here's the note that I worry about. It looks like it's starting. So this is a chart of bankruptcies, and it looks to me that the current interest rate environment is taking its bite out of a leveraged corporate America, and this is a very disconcerting chart to me. This is another chart that just mimics what the last chart was, but it puts a number on it. It shows you the I guess the magnitude of what's to come. And this is a very, very small number right here. Sort of 250 or 300 billion is very, very, very small. There's likely to be 1.4 to 1.5 trillion of commercial real estate coming due between now and the end of 2024. That's just commercial real estate. And most of that is backed by some amount of actual bricks and mortar, which is pretty good. And in the corporate level, it's almost impossible to figure out what is coming due, what bond maturities are coming due, but it's in the trillions also, in the several trillions. That's all we have for today. If there's any attendant questions, I'd love to answer them for you. And if not, or if you feel more comfortable talking to them offline, I'll be here until about 6:30 Eastern time. Marissa, is there anything else?
No more questions received, so that's all on my end.
Great. Sorry to be over today, guys. Thank you so much for spending some time with us and going over this. And if there's any comments or questions or topics that you want to cover in the next one, please let me know. We're going to have it either in August, or we might skip August if everybody wants to take a break, and see you during September. We'll send out a note. Be well.
Thanks, everyone. Have a great weekend.